Today's investment webinar will be hosted by Dhruv. Dhruv is our CEO here at Syfe, and he's also joined by Richard. So Richard heads portfolio construction and risk management. Right, so over to you, Dhruv.
Hello, everyone. Melvin, can you see my screen nice and well? The customary first question before every webinar these days.
Looks good.
Okay, great. Hello, everyone, and thanks for joining us for our webinar today. I'm very happy to do this alongside Richard. Richard and me, I think we go back now, I can say very, very long, when we first started speaking about Syfe almost back in 2017. And we're really happy to, come this far, but at the same time, tell you a bit more about our algorithms and how we actually strategy and how different portfolios work. Now, I would like to caveat, and I think Melvin touched on this earlier, this is a bit more of an advanced session. So, if some things, seem a little too over the top, I mean, that is somewhat expected because that's the purpose of the session. But feel free to, keep the questions coming because both myself, Richard, as well as Melvin, all three of us will be here to answer your questions along. So then let's get straight into it. So essentially, currently we have 4 main portfolios which we offer. Now, this might sound a bit overwhelming because, well, it's 4, but the reality is there are 4 actually extremely different, serving very different purposes. I think something that we've just, launched recently, which has been doing extremely well, is the Syfe Cash Plus. This essentially is more targeted and more, bent to those who are actually trying to find a solution to actually manage their money in a very low risk kind of a method, almost like a smarter alternative to saving bank accounts, if I may speak, right? This is always invested in high quality money market as well as, short duration bond funds. So we either use treasuries or we use investment grade corporate bonds. And the projected yield of this is actually 1.75%, relatively very stable. Again, no lockups, no limits, no tiers. The second product, which I think a lot of you know us probably most well and also very, very unique to Syfe, is the Syfe Read Plus. This was actually built in close collaboration with the SGX, and it tracks the iEdge S-Read Leaders Index. Now, one of the key purposes of this product has been around yielding dividends. And a lot of customers find value in some sort of a product like this, almost to generate some sort of a passive income, which typically comes from the dividends, but at the same time also have exposure to the real estate property space. And it's been quite interesting because, this is one of the strengths of real estate as a sector, right? I mean, I think 6 months ago, everyone was jittery, what's going to happen? Is things going to come back? But just like many other things, the rebound has been phenomenal in this space as well. And in fact, even some of the concerns around office and commercial, REITs have been, alluded and something, we can address more about. Now, growth, and this is where actually I would say our algos come at their prime, and also something that, today's session will largely focus on, is somewhat more on the side of those who are looking for high growth ventures into their investments. Now, what we started off with, which was actually, some of you might remember as our first flagship offering, was the Global RE, which actually stands for Automated, Risk Managed Investing. The purpose of RE is very simple. The purpose of RE is to manage risk. And in reality, the reason why we say risk management is important, and something that we will, come to earlier, is that we've always felt that when it comes to returns, of course, there are portfolios which will generate good returns and bad returns. But sensitivity around risk is something we have seen has become a very, very common theme around some of the investors, especially out in jittery times. And having that level of balance, which is then diversified further across, assets such as, gold or companies or stocks or equities and bonds, brings a very blended solution. So focus out here is to actually protect your downside. And what we actually do is when the markets start reacting in a way which seems unfavorable to, your risk profile, we will rebalance to bring it back into that profile. Now, something that's more recent, which we launched, middle of last year, was the Equity 100. This is built on, a very interesting, and I would say for the first time, actually, something very unique becoming available to the masses, the smart beta strategy, and something, Richard will actually, talk about as we get along in today's presentation. This is a 100% equity portfolio, always and always focuses on equity, of course, has done phenomenally well last year. I think the return was close to 23-24%. But of course, with high risk comes, with high rewards comes an element of high risk, and something every user should be conscious about. Something that we can talk a bit more about as we get along in today's session. So let me get straight into it, right? The first of the investment strategies is RE, which I mentioned about, the automated risk managed investing. This is used currently in 2 of our portfolios. It's used in our global RE portfolio, and thereafter it's also used in our REIT portfolio with risk management. As some of you might know, in the REIT offering, we either have an option of 100% REITs or an option to manage with risk, where based on RE, we might sell some REITs and buy some of the underlying Singapore government bonds to safeguard and cushion you from some of the market corrections. And this is actually done very well last year. I'll probably actually have one of the slides which will show you how the performance had been in 2020, which is, I think, a very important year, because especially if you go back to like March and April, we saw the best and worst of investor behavior, right? And sometimes, having a solution like this can really help you to stay invested and stay focused on your goal. Now, the premise of this is very simple. This is what we maintained from day one, right? Returns cannot be predicted. I mean, we had equity 100 last year giving 23% returns, right? Will it give 23% this year? I can't say, right? Will it do well in the long run? Probably, but can I tell you what kind of return it will give? I really can't, right? It could be 10%, it could be 20%, it could be 5%. What we have realized though is that risk can be managed, and that is the premise and the core of when it comes to RE. What we're really trying to do at RE is to manage the risk, because that is the only thing you can manage. You really can't, build your portfolios which are geared towards returns in some ways, because then of course we always realize, you should just invest in multi-leverage, high margin, future contract. And of course, if it goes up, you might make 10 times, but if it goes down, you could lose everything also, which is not really what we are here for. We're here for more of a, I guess, an investing vis-a-vis a trading platform, so as to speak. Now, one of the reasons what we saw, and this is, some of the numbers that we'd run, if you see these numbers were, for the last 20 years, you actually see a very, very strong correlation when you look at, if you look at the spot volatility and if you look at the forward volatility, what that means is that if you compare, the current volatility as well as the future volatility, and volatility in some ways is a proxy for risk, you actually see a relatively, strong correlation between the two, right? Which, as you can see, is 0.6% out here, right? Or rather, not 0.6%, but 0.6, which is on a scale of 1 being like perfectly correlated. That's actually a very, very high correlation, right? Now, on the other hand, when you talk about returns, as you can see on the left of the screen, that you can see is a bit more scattered, right? I mean, 1 week you could be +5, next week could be -5, 1 week could be -5, next week could be -10. It's really all over the place. There is nothing, it's nothing like the volatility chart that you see on the right. So we've actually seen that there's a big correlation which actually happens when it comes to managing risk. Whereas in returns, and which we've always said, there is actually not much of a correlation out there, right? And this is something that, we try to explain to our customers, which is also the reason why we are trying to manage risk, because you can manage risk, you really can't manage returns. And, past data actually is a very, very good proxy to explain the same. Now, the other question is, all right, great, you can manage risk. Great, that we find there's a correlation in risk which can be managed. The question that comes is that, why manage risk, right? Why do we even need to manage risk at the first place to begin, right? And the reality is that, and this sometimes people, forget that if you have a drawdown obviously is a correction in your portfolio, the time and the effort it takes to actually recover is much more than what you might think. And let's take a simple example, very close to probably what happened, in March this year. If the market comes down by 30%, you don't need a 30% recovery. You need close to like a 43% recovery, right? And if that number actually, just keeps on going much, much more if you go down. So in reality, what we are saying is that if somewhere you can kind of capture you losing less, right? It would basically mean that what you have to recover and gain itself becomes less, right? And that is somewhere the premise of, risk management, right? Somewhere if we can actually, ensure that as a portfolio level, you're kind of protected from the wild moves that happen on the way down, you have actually, a better chance of recovering and getting back to where you were to begin, and eventually even above that, right? And the other thing is that, when it comes to, some people say, oh, but how often, do these drawdowns happen, right? And if you think of it, and I mean, again, last year was a great example, right? is that you essentially, these probably happen much more than you think. On average, as you can see on this chart, it normally happens once every 3 to 3.5 years, right? And the point is that, again, given the fact that this is an investment platform, given the fact that, we expect you to stay invested for a longer duration of time, it is quite likely that your portfolio at some point will face that event. Now, if in those scenarios we can actually manage the risk, or rather have you lose less and stay invested, vis-a-vis you panic, you hit the sell button, and I'm sure there are people out here who would have hit the sell button in the worst of March, you eventually end up, losing out on what eventually comes, which is the rebound, and as the markets correct. And the premise is, of course, over the long run, the markets will go up. And I mean, that's a discussion, which we'll be happy to have. But as value of money keeps on going down and as general inflation increases, you will see the general trend is upward. So if you stay invested, right, you are definite to reap the benefits. And we do this thing about, investing and say, if how investing for the long term and having time on your side is one of your biggest strengths. The problem, of course, is that do people stay invested? Will they be disciplined, or will they panic out when these things happen and then eventually, hit the sell button because some things went wrong, right? So I think the key difference, and some people ask us like, and of course there are a bunch of differentiators, the way how we structure our cash product, our REIT product, access to wealth experts such as Melvin. But I think one of the things we always mention about is how, we truly focus on risk management, right? So as you can see on the top and, lower part of this chart, on the top part of it, if you see traditional asset management is more about, oh, I will give you the 60, 40, 80, 10, 10, 70, 30 kind of combination. And I will just try to focus on this asset mix. I will not really look at risk, right? And hence the risk profile actually, if you can see, just keeps on moving much, much, much over time. Whereas our view is that what we should actually focus is a bit on the risk. We actually focus on the risk and we keep the risk constrained, within a particular range, let's say, which is the user is comfortable with. And we will let the asset allocation then change accordingly, right? Because again, if you go back to our earlier premise, managing risk is the right thing to do because returns really cannot be managed, right? Now, bear in mind, of course, if you are looking for outsized returns, of course, an equity 100 and products, which we'll talk about, which make much more sense. But there is obviously certain of you who are more likely to panic, more likely to sell if markets go down and so on. And we actually ask this question, like, market goes on 30%, will you sell? And some people are, yes, I'll sell at 10%. And some are, no, I'm happy, I'm here a long-term investor. So if you are in the former camp where you believe that, you'll panic, I think then this product actually is very, very, apt in some ways for you, right? And I think this is one of those things about where rather than targeting an asset allocation, the RE more targets a risk allocation per se in that regard. And which is what, gets me to, I guess the last part, at least in this presentation. Now, I was mentioning about, this methodology also getting used in REITs with, risk management. Now, if you look at this chart actually brings out, two aspects. If you look at, the blue line is essentially the 100%, allocation, out to REITs, right? Whereas if you look at the REITs with the risk management, right, for that matter, you can see that's a golden line. You can see essentially the drawdown, or rather the correction, is actually much lower, and hence, the recovery and hence the original margin is much higher as we get along. Now, this is very interesting because if you look at those two like red spots, that is when we actually did the rebalances. You can actually see what the rebalances were. And if you were a customer, this is something you would have actually already, experienced, right? And this actually, again, if you remember some of the earlier points I mentioned about managing your drawdowns and recovering and so on and so forth, you can see the difference in these two in a year like last year. Like in 2020, the 100% REIT portfolio, of course, remarkable recovery from the worst. It was almost down 35%, as you can see in the third week of March. Actually end up the year pretty much at flat, right? Coming back to that premise that markets will rise up in the long run. But the risk with the REITs managed, it actually outperformed, and it actually ended up the year up 5.5%, right? So again, it's something which is a bit individualistic as to what you really, prefer. But I think, depending what kind of an individual you are, what your goals are, and what your risk appetite is, whether you choose a risk managed approach or a not risk managed approach, that is completely up to you. If you look at it, in fact, if you look at the last, 3 to 5 years, you can see the REITs, with the risk managed, actually, in the short duration, in fact, the last years also has actually outperformed. But there have been certain years where you will see that, 100% REITs has kind of got a higher, yield per se. So again, it's something, for you to consider about where your preference is. But, this or last year, and in fact, these red dots are a prime example of seeing this in action and actually seeing how these things, work out in reality for your portfolio. Now, one thing good to know is that for at least the REITs portfolio, if you choose the risk managed option, we still have a minimum floor of 50% in REITs. So you will always and always have enough exposure to REITs. It's not like REITs will become like zero and 100% can be bonds. No, that's not the point. This is still a REIT product. But again, of course, depending on where the market conditions are, you can probably have lower than 70-80% exposure. Yeah, I mean, you can be as low as 50%. And in fact, for a wide variety of last year, we were at 50%. But in reality, if you fast forward the year where we are today, it's actually done handsomely well and has in fact outperformed 100% REIT portfolio. With that, I'll maybe just pause for a second before we go to the next section. Any questions, right? Let's, Melvin, any questions that we wanted to address before we get on to the next section?
Maybe one for the REITs portfolio is that people are wondering if they can actually split between the REITs portfolio, the risk managed one and the non-risk managed one.
Yeah, sure. I mean, the reality is at Syfe, right, our goal is to give you access to as many things as possible. You can build as many portfolios you want, and you can split between risk managed and non-risk managed. And the good thing is, and some people are sensitive, to become a black or a gold tier because of preferential pricing. When we look at those things, we will look at the aggregation of all your, portfolios, leaving cash plus the product. But let's say if you have 50,000 in REIT and 50,000 in REIT with risk managed, overall you still have $1,000 invested with $100,000 invested with us. That puts you in a gold tier and hence a much preferential pricing, right? So you can have as many portfolios as you like and as splits what might be suitable for you.
Great. So another one for cash plus, is it capital guaranteed? And if it's not, maybe what's the potential losses?
Yeah, great question, right? So at the end of the day, capital Cash Plus is an investment product. It is investing in very, very safe products. Approximately the split is roughly about 60% government or government-linked treasuries. In fact, one of the biggest holding is, MAS and Singapore kind of, government bills per se, right? And then the rest, 40% is in, investment grade bonds, right? Of, again, very highly reputable, corporates and corporations like Standard Chartered and so on and so forth. So technically, right, I mean, if the only way this portfolios genuinely lose money, and I'll come to the point genuine in a second, is when these underlying, providers themselves default, right? And they just default. Now, temporarily, if the rates move, they can be a little bit up and down and fluctuation. But in reality, if you hold a bond onto the maturity, they will pay what they pay, at the thing. So basically, if you hold it enough, you will get, your, I guess, base investment plus, the top up they've, promised, right? Even if there are these small up and down fluctuations. Now, the only situation that doesn't happen is one of these default. But therefore, the reality is given that a vast amount of is like in government securities and, 40% is again in very, very high quality, corporate investment grade bonds. The probability of this happening actually is very, very low. Now, I say very low, I would not say zero, because at the end of the day, if it's a massive company and something happens, then there is a possibility this will happen, but it is extremely, extremely low. Case in point, I think this is probably the most proxy point, is that at the peak of COVID, when there was a lot of uncertainty, futures were not sure of not just governments, but also, how do I say, big corporates and corporations. Even at the peak of COVID, the entire portfolio only had a correction of 0.7%. And it was a very short-lived correction. In fact, in the year, if I have to do the year, it ended the year at actually, I think, offering like 2.5% plus. So it actually ended up gaining much more because the yields actually came off, and these bonds, when they were held till maturity, they were giving a much better yield than, what the revised yields were. And that worked in its favor, right? So to answer your question, it is possible that a part of it, can, work. But again, because it's so well diversified and so spread, even if one company defaults and all, in reality, the impact on your portfolio is very, very limited. And even at the peak of COVID, it was only 0.7%. That was temporarily. If you held it for 2 weeks, it would have recovered back, and you would have actually, get your promised yield as was promised by the underlying product.
So maybe a couple more, yeah?
Sure.
So I think one interesting question is that what are the factors and indicators used to shift the whiplash composition to 50-50 back in 2nd March 2020?
Yeah, sure. I think this will be a great point for Richard to come in. Richard, would you like to take that one?
Okay, I think basically the factors is just volatility, right? Because the whole idea really is that if you manage the portfolio to a certain risk level, then what we do is we target, that the drawdown shouldn't be more than a number, right? And in this particular case, I think the drawdown risk that we're targeting or we're managing is about 15%. So the whole idea really is that if volatility of the underlying REITs pick up, and when we do a Monte Carlo simulation that the drawdown could exceed 15%, then we basically de-risk. We basically sell REITs and buy the government bond ETF, right? So that's how we manage it. And as you can see, that in March we're managing to that kind of a profile. Now, obviously, it is not a hard floor because we have a minimum holding of 50% in REITs. So if the REITs really fall through the floor, let's say if the REITs went down 80%, we couldn't promise you that you only lose 15%, right? Because if you have a floor of 50% REITs and REITs go down 80%, half your portfolio is down 40%, right? So I mean that hasn't happened, but the whole idea really is that we target risk.
Yeah, that's the key point. Yeah.
Great. So maybe another one. One participant is asking, his RE portfolio just got rebalanced. So can you explain how the rebalancing works? Does the system sell some ETFs and buy others to achieve the target risk? And who decides what risk percentage any specific ETF should track?
Okay, let me sort of answer that. It's kind of in the same vein. The whole RE model is focused on sort of downside risk. Okay, so in essence, you are the one that decides how much risk you want to take. Okay, so let's say our most popular portfolio is 15% downside risk. Okay, now over time, on average, right, you can compare this to roughly a 60% equities, 40% bonds and gold portfolio over time, right? But if volatility is very low, the equity component will go up. If volatility is very high, the equity component will come down, right? So as you can see now, the volatility in the markets are quite high. That's why most of our RE portfolios have a lower than usual equity component. Okay. Now, how do we rebalance? We basically rebalance by saying, hey, if we target 15% downside risk, we have a so-called risk corridor. So there's a plus or minus, so that we don't keep rebalancing all the time. There's a transaction cost involved. So this corridor is more or less, depends on market volatility and so forth. But we manage it to a risk corridor. So if it breaches the risk corridor on the upside, then we will de-risk. If it breaches the risk corridor on the downside, then we will basically add more risky assets so that you can participate. Right?
Great. So thank you, Richard. But I think another question that seems to come out is the currency impact regarding the global portfolios. So you might want to address this one. Like, do we do anything to hedge the currency impact?
Unfortunately, the problem is that this is obviously a kind of a holy holy grail type of a project, because as you know, right through the last 20-30 years, the US dollar has been depreciating against the Sing dollar, right? So or Sing dollar has been appreciating. Now, so the problem is, if you know that's going to depreciate, why don't you hedge? What we found was when we did all our testing, if you hedge, you just keep hedging passively. That means, in other words, you don't think about it, you just keep on hedging. Cost of hedging dominates the devaluation, okay? So what that means is that if you just keep hedging and hedging and hedging, you will lose more than if you just held on to the US dollar, right? Now, the US dollar in some ways is kind of a part of, I guess, the investment risk process. So if you look at it on a very short term, the US dollar has come down. If it goes back up, so it's kind of a little bit of I don't want to say a crap shoot, but basically, it goes up and down and you can't forecast it. So what people do when they try and manage risk is they try and time it. Okay. So what happens is that, okay, I hedge at a certain time and I unhedge at a certain time, because every time you hedge, there's a cost to hedging. So you must be relatively sure that when you hedge, you can then protect the downside, right? But a lot of times when you hedge, you don't, you end up paying and you don't protect anything, right? So the whole idea really is that how do you basically design, a currency hedging timing model? And so far we've been trying, and I think a lot of people have been trying, and it's a very difficult problem to solve. Okay, so this is something that we have not solved yet. And I think if you know somebody out there who has solved the problem, we will be happy to sort of work with them, to try and address this particular issue.
Yeah, I think, just to add, I think this is something that we've actually looked at almost, I think, Richard, almost the first time, almost 2 years ago, if I'm not mistaken, right? And I think the point you make is very good, right? That cost of hedging is much more, right? So in reality, even if you think that, you can probably hedge it and, it might sound great because you've seen this big move. But at the end of the day, if you go back where today it is, and if you see where, SGD, USD was maybe 12, 18 months ago, right? You realize that, that difference actually is small. The reason why I say this is that if your general view is in the long run, as a long-term investor, right? What we realize is that currency impact generally in the long run is a much shorter place than actually your portfolio impact. And if you take a step back, the reason why you're investing in a global or in an equity 100 portfolio somewhere is for a global diversification, which is away from, your home country in some ways, right? So basically away from, our, jobs and our CPF and our home, etc. in Singapore. So when you do that, right, I think it comes some sort of like as a combined package. But the reality is, because we had that really sharp move, which happened, in the month of March and April, which led to, USD really strengthening, everything kind of weakened out. But bear in mind, this could again go the wrong way. Eventually, once there's another strain and new virus, and if people again start, hunting for like safe assets, USD generally is that kind of safe asset, and you could again see this currency move up, right? So our view is that, like, that essentially the cost of hedging versus the purpose you're trying to achieve actually, does not really make, any sense at all. And it's a conscious choice that we don't hedge. But of course, if you are, if you understand that concept well enough, it should be a relatively easy thing for you to do yourself, on your side. We have some investors, by the way, someone asked, what can we do? We have some investors who just invest in USD. So they have this USD performance, but it's basically the same thing. But, you just don't look at the SGD number day to day, right? You know what I mean, right? If your end currency is SGD, then that's always going to come and bite you at some point or later. But psychologically, some people feel better that it's just a USD investment, and they feel that it's better because it's more holistic and it gives them more diversified exposure, as the case might be.
I think if I can just extrapolate a little bit more on that, right? In the perspective, it's actually a question of perspective. Now, I know it doesn't help you. I mean, if you're a Sing dollar investor and you invest in a global portfolio and the US dollar devalues, right? But think of it like this. Ask yourself this question, right? Why should you invest in a US dollar portfolio in the first place, right? You can obviously just buy, Sing stocks, Sing bonds, and just stay in Sing dollars. Then you have no currency risk, right? But the problem is that if you
have gain, then, right, Richard?
No.
You have no currency and no gain, right? So
yeah, exactly. That's exactly my point. Is that basically if you just invested in the STI, for example, okay, you compare the STI performance versus the S&P, okay, then basically what you're doing is you're picking up the risk premium for investing in S&P, right? But then you're giving back the devaluation. You follow? Right? So the whole idea really is that if you don't want currency risk at all, just invest in the Sing stocks. But your opportunity cost is something that you don't crystallize, right? Whereas when you invest in US dollars and then you have a return from the US dollar investment, but you have a devaluation, then you say, this is so painful, the devaluation, right?
Yeah, and I think that is something which is about coming to terms with, right? Which obviously gets very tricky sometimes for users, right? Let's take some more questions, Melvin. What do you think? Because there are a bunch of them I can see. So
great. So maybe a good one is that Syfe buys commodity like gold as a hedge for the global portfolio. So with gold prices being at all-time high, do you think it's still a good idea for individual investors to accumulate gold?
Okay, okay. This actually relates to, for example, the question, that some people ask about inflation, right? They say, okay, US bonds, the yields are going up, are you a bit worried, that there's inflation is coming on, right? So gold is kind of tied to inflation, but don't think of just inflation, think of what they call real interest rates, okay? Now, think about it, if you buy gold, you have no interest rates. I mean, basically you get paid zero, okay? So the only thing you get is upside, right? Now, what drives this upside, okay? What drives upside is the cost of carry, right? Now, the cost of carry basically is your inflation, right? But how much you get paid as a bond for this inflation. So right now, for example, the real interest rate, so which is basically inflation minus the bond yield, is negative. So what this is saying is that if you have a negative carry, right, then gold, because it's an inflation hedge, is something that you can invest in. So the key to look at it is not how high has gold gone or how high has inflation gone, but what is the cost of holding gold? And if it's negative, then we will still hold gold, right? Because you're outperforming the bonds.
Yep.
Does that make sense?
Yep. Makes sense to me. Hopefully makes sense to anonymous attendee who asked that question. Yeah. So, I saw one slide that maybe Vivian has actually helped us upload one slide in. I think someone was asking us quickly a bit more about, would be good to know who is Syfe, what is the Syfe history and all. Because it's a deep dive, but fortunately I managed to just get a quick, screenshot in which might just help, address this out. So basically, just to, as I was mentioning, I think, September 2017, probably I think the early times when I think me and Richard started speaking about Syfe. But basically, the year and a half after that actually largely went in getting our license as well as launching up with the global portfolio. And as you can see, over time, we've launched the REIT, Equity 100, and most recently Cash Plus. We are actually, well, I think that slide needs a bit of an upgrade. We're actually 50 plus now. We come from different backgrounds. As you can see, some of the leading banks, globally, but also some of the leading, local institutions. And along with that, you will also see a background of, technology focused firms such as, Adobe and Lazada and Skyscanner and etc., as the case might be. You obviously know myself and Richard. But of course, some of the key people in the team, are obviously, Sebastian, who heads all our distribution efforts, Akiko, who's a senior financial engineer, as well as a risk manager, and is a PhD and focuses on, well, a PhD in astronomy, but has been working extensively as a portfolio quant for the last, I would say, almost 7 or 8 years. And then Ritesh, who joined us from Goldman Sachs, who heads up our, investment advisory unit. The next part of the question was who has backed up. We've actually been backed up by some very prominent investors globally. But I think the most recent one was where we completed our Series 8 fundraise, which was of $18.5 million US, close to about 25 million Sing dollars, making it one of the largest, Series 8 fundraisers probably in the world, but definitely in the region. And this was backed by Valor Ventures, which is a New York-based fintech-focused investment company. You might have heard of some very popular brands such as Xero and TransferWise. They were the early backers of it. They've also backed companies like N26, which is a leading digital bank in Europe. So some very, very, prominent global, very successful fintech companies have been backed by them. And we're very happy and proud to have them as our backers because we were their first investment in Asia. So I think it speaks a lot about, I think, what we are building as a team and what we are trying to really offer to our users. Back to you, Melvin.
Great. So shall we move on first for now?
Yeah, sure. Let me get on the right slide and then we can get everyone interested. All right. So Richard, this is up to you now. This is probably the most technical part of the presentation. Hopefully Richard, you're on mute, Richard.
Okay, so let me just give you a background. Drew, the previous slide before that, just the header slide.
Yeah.
Let me just give you a background about why and how we created Equity 100. Equity 100 was created because when we actually went through this risk management process, there were quite a number of clients who basically felt very uncomfortable that we were rebalancing through the drawdown, okay, in 2020 in March and so forth. And there was a lot of feedback, and the issue was, hey, why are you guys doing this, rebalancing and so forth. So although we try to educate the investor base, but when the rubber hits the road, a lot of people were uncomfortable with all this trading, right? So one of the things that we decided was, okay, if there are enough customers that feedback that they don't like this rebalancing, you are micromanaging risk, and then the market rebounds and so forth, then why don't you give us something, that we can actually manage ourselves? And, there's obviously this dollar cost averaging that seems to be very popular with our investors, okay? So what we did was basically created, this particular product, but this product is not created from nothing. This product actually was carved out, from our RE product, okay? So what we did was we took the equities out of it, and we say, okay, look, why don't we just don't manage risk? Okay, we just take all equities, and then we basically create a product that will outperform the equity benchmarks, right? But we don't manage risk, it's always 100%, in equities. Now, how do we then beat the benchmark? So we basically use this concept called a smart beta tilt, okay? And we call it smart beta, but actually we're just tilting, okay? So maybe the next slide.
Yeah, I'll just caveat, I think we are just going a little bit slow on time, so maybe, you can work on the project. Yeah, all right, but let's go for it. Yeah, yeah. So you need some Q&A also, right? But
yeah. Okay, so what is smart beta? I mean, basically what smart beta is something, for those of you who don't know, I mean, basically what beta is just investing in an index, okay? And alpha is what a lot of active managers try and outperform the index. So smart beta is saying, look, a lot of the outperformance really doesn't come, from picking the stocks, but it's really risk premium, systematic risk premium that you're harvesting, okay? And this concept, about, 30 years ago, was conceptualized by these two professors from Chicago called Eugene Farmer and Ken French. So they're called the Farmer-French factors, okay? And what it does is an extension of the capital asset pricing model. And the whole idea really is that if you basically tilt your portfolios towards these so-called factors, systematic factors, then you can actually outperform, the passive benchmark, okay? So the three that we've picked is growth, size, and low volatility. Okay, so the next slide, please. Okay, so growth, what is growth? Growth is that, stocks that have shown, good growth performance over the years, and typically this would be kind of like the tech stocks, the biotech stocks and stocks that actually have a lot of growth, okay? So we basically invest in this factor. We invest in volatility. We found, the academic studies have shown that low volatility basically gives you the same returns, but with 2/3 of the risk, okay? So you invest in this kind of factor. And then the third thing, is size, okay? Now we choose large size, but those of you who know Farmer-French, okay, the next slide. Those of you, who have gone through and looked at Farmer-French, this is the Farmer-French model, okay? The three-factor model that they did in the early 90s. Now, what Farmer-French says is over time, SMB is small minus big. That means small stocks typically outperform large stocks. And basically, high minus low is high book to price. That means the value stocks. Okay, so if you're loading on HML, you bet on small stocks and you bet on value stocks. So the question you ask is, hey, what are you guys doing? The factor designed by Farmer and French says you should be small and you should be value. And you are doing the opposite. You're saying, I want large and I want growth, right? So why do we do this? Okay, next slide, please. So what we do is, okay, if you take a look at over time, which is what Farmer and French did, which you look back 30, 50 years, okay, it is true. There's a mean reversion process, and basically you should bet small and you should bet value. But in the short term I don't mean very, very short. It's like 3 to 5 years. There are trends. That means basically you can, the value can be going down. And so you can see this orange line is actually value. Okay. So value over the last, sort of 3 to 5 years, maybe a little longer than that, has been going down. Okay. And then you can see size also, the size factor also has been drifting down. Okay. So what we do is we look at things like this, the trend of the factors, because you see factors, don't kind of rebound straight away. The cycle is relatively long, it's in years, right? So what we do is we look at this trend and we say, hey, well, looks like value is out of favor, growth is in favor, and look at the size, looks like, large size is better than small size, right? So that's how we picked some of these factors, okay? So next slide, please. Okay, so now having picked the factors, you say, okay, look, you want to go growth and you want to go size. How do we do this? Okay, so we don't pick stocks. Okay, we use ETFs because ETFs firstly are liquid. Secondly, the cost is very low. Okay, so we basically look at candidate ETFs. Okay, so QQQ is the ETF that's very liquid, very low cost, that basically tracks the Nasdaq 100, which is a growth. So you can see how do we decide how to build this. If you look at this, this is a little bit technical. I guess those of you who's gone through a linear regression class kind of can empathize with this, right? So you can see what we do is we run a regression of QQQ's returns over the farmer fringe factors, okay? And you can see that basically market minus risk-free rate, this is kind of the traditional beta. So you can see QQQ has a beta of 1.12, which means it's 12% more volatile than S&P. S&P is over here, it's 1.01, right? So this is kind of a leverage bet in a sense, okay, on the market. But you can see it's negative. That means this is large stocks. Negative means large, right? Because SMB is small minus big. So if negative, that means it's big, okay? HML is value, okay? So if it's negative, that means it's anti-value, which is growth, okay? So you can see when we basically invest in QQQs, what we're doing is we're investing in size and we're investing in growth. S&P, you'll notice there's no value. You can see the P value, the T statistic and the P value. That means this is roughly 0, okay? And then this one also is large size, but it's not as large size as QQQ, okay? It's less negative. And the beta is more or less 1, okay? You look at another ETF called RSP, which we also look at. And RSP basically also has only about, not very leveraged in a sense. And you can see, look at SMB. That means it's small size, okay? Now what RSP is an equal weighted S&P index. So obviously you have smaller sizes, right? You compare the S&P, which is large, negative. This is positive, so it's small size. And then this one here is value, right? Because it's positive versus negative, okay? You can see it's negative here, it's positive here. So if we wanted to bet on value and size, we would then use RSP, okay? Okay, next slide, please. Okay, so what we believe is that factors drive investment performance. Now, the colors didn't come out quite correct, but let me tell you, the blue line is QQQ, the black line is SPY, this is the S&P 500, and the green line is RSP. So you can see that actually the proof of the pudding is in the eating, right? The performance actually, validates, the factors that we saw. The factors were trending down. Remember, value was trending down. So you can see value here, green, underperforming growth, which is blue, okay? And size, small size, underperforming big size, okay? And take S&P as kind of the neutral, right? So you can see size and growth, large size and growth, small size and value, okay? Next slide. Okay, so how do we put it all together? We basically then, say, okay, we'll start off with, the world portfolio. So global market equities, we took the world portfolio. This is like an MSCI world, okay? And then we say, how do we tilt this so that we take advantage of this systematic smart beta tilt, right? And then we basically built it using the ETFs that we've chosen, right? So this one is size and growth. And then these are the sector funds that we put together to basically create a low volatility portfolio. Okay, so this is how we ended up with the asset allocation that we have, which is actually quite, you can see it's quite diversified. Of course, with a heavy tilt towards information technology because of QQQs, right? And then consumer staples, is the other large guy, because consumer staples kind of contribute to the low volatility, right? So this particular portfolio, I think Drew will probably go and talk about the performance. But essentially, I mean, we're getting, a higher return for the same risk. Okay.
Yeah. In fact, I would say like slightly, if you look at like standard deviation, slightly lower risk, in fact, right, from the S&P 500, but actually getting high performance. And this is not just in the past. I think last year was a prime example where it actually had an extra, 4 or 5% outperformance to SPY. So people ask, well, why don't I just go in the SPY? Well, this is the reason why you do. And this is something, which has happened consistently, right? I mean, last year people experienced it firsthand, but you can see this trend actually continues, over time, as you look back in time. So last year, I was mentioning earlier, the performance of this product was plus 23%. Some people, of course, absolutely love the product because it has, it's kind of that, that the smart data on typical index by putting the factors that Richard alluded to earlier in some regards. Now, one quick thing that we want to address, and I think this is, one of the things that we hate what happens sometimes in the industry is people normally, talk about, dividends and, withholding taxes and, using usage and so on and so forth without completely understanding what it actually means. The reality is that we actually pay a lot of impetus on what ETF we choose. I mean, obviously Richard with extensive experience in risk management, and for me, like, I was responsible for the ETF product when I was at UBS. What we basically realize is that essentially, sometimes people think, oh, the UCITS have a lower withholding tax, which is true. So they have the right product, but this is a great example why we choose QQQ over, let's say, EQQQ. The reality is that though the withholding tax is much lower in, EQQQ, if you look at the management fee as well as the post-tax dividend, when you add those aspects to, together, you actually realize that tax benefits of EQQ are actually offset by the higher management fees, right? So essentially what you are getting is an extra 3 basis points, but you lose 10 basis points. And I'm not even talking about liquidity and transaction cost, which is a whole new perspective. So we actually look at these factors once we decide. In fact, I think as Richard was mentioning earlier, if you look in the composition, if you're looking in the composition slide, you look out here on the top, the S&P ETF we use is actually a UCITS compliant ETF because there we think it makes sense. But when it comes to, the ETF, such as, QQQ, using the US line actually makes much more sense. So we actually do this for you. So don't, fall for this, policy that UCITS are better just because, or funds are better. But the reality is look at the actual numbers when it comes to deciding what is the right offering for you. Now, I see a bunch of questions, but let me just quickly, get through this how to start session. Now, of course, it's a very straightforward, a very easy process. We start with a portfolio recommendation, or you can choose a portfolio to your liking. You carry on with, the regular onboarding, which then eventually also shows you some sort of a forecast as to what you can expect in good, bad, and, average case scenarios. And thereafter, through a beautiful app, which is about to undergo a very, very big and a very healthy revamp. I saw someone ask this question. You will see also a tool for a very regular and very easy monitoring. So it's very simple, especially if you're, if you're tuning in from Singapore and if you have a Mindful account, the time you take to set up is basically, sub like 5 minutes, right? If you don't have it, you can still on board. It's slightly longer, but, net, the entire process is still about 10-15 minutes, which I think is, a very, very short amount of time to spend to, build your financial fortune for the future. Everything you see is completely transparent. In fact, we pride ourselves in transparency. You can see our portfolios even before you invest $1 because we actually feel what we've built, they can't be replicated. You can't just go to a broker and start buying them. You will soon realize that it's not going to be worth financially and definitely not worth, for the time and the constant monitoring in that scheme of things. Now, one thing that we've always, been proud at Syfe is that we want to be transparent in our offerings and be very, very clear with what users are getting. And this is a theme you will see throughout our platform. So when you see our fees on the Syfe side is completely inclusive. We don't charge any extra trading fees. There's no entry exit. There is no minimum. You can withdraw as much or as little as many times as you want for no charges. You can rebalance. You can, move between portfolios as you like. And of course, whenever we choose ETFs, as you saw in one of the previous slides, we make a conscious effort of choosing the right ETFs for you because we understand that, eventually these also add up into your cost and hence, your performance. Now, what does it actually cost to get on board, right? Now, we essentially have 4 tiers for our customers, blue, black, gold, and platinum. This is also on our website, so don't worry if you can't, get all of it. But the reality is the fees, when you're just starting off, it's 0.65 basis points. But when you move to gold and beyond, it actually goes down to 0.4% and even lower actually if you end up, into a platinum category. Now, the big advantage is that when you come into the black, gold and above categories, you actually end up getting a dedicated, wealth expert. If you're lucky, you might get Melvin, but who can actually help you, with your journey and actually make you understand how our products are, more suitable for you or what might be right for you. Now, again, this is completely optional, but up to you. But a lot of our customers find value because they understand how these offerings can actually, be more helpful. Now, Cash Plus is one of our more recent offerings, done phenomenally well over the last, month or so since we launched it. The management fees is completely zero. There is no charges at all on this. You can put as little, as much. It's not all those tricky things where, you have to, deposit your salary there and make 5 transactions and then, have your grandmom open an account, only then will you get 1% return. So essentially, this is a very straightforward, again, a theme you will see across the platform. We want to have simple, straightforward, transparent products that you can use. And I think this slide actually just tells you, exactly how these things are structured. Now, one common question we get asked is that, why can't I just, do this thing myself? Now, essentially, the list is endless, right? But let's just go down these things. Firstly, there's no minimum investment. If you are investing you can actually invest in $1 and get a smart beta product access, right? Which would typically reserve if you only have, a few $1 million and above in some ways, right? You don't need a CDP or brokerage account. You can literally just, it is all like done for you in some ways, right? Because we all manage everything on your side. The time required is minimal especially if you sign up through My Info. It's not like, paperwork and, your sign did not match and can you please courier here and stamp here, so on and so forth. Plus, also a lot of really cool things such as advanced risk management, auto rebalancing, automatic dividend reinvestment. We don't talk much about dividend reinvestment, but just to give you a scale of things, if you have just reinvested every dividend that you got, on average in the last 10 years, you would have made an extra 0.5%. And the reason why people don't do it is because even if you invest, I don't know, $100,000, the dividend that you might get on one particular stock might be just like $200 or so on and so forth, right? You really can't invest $200, so people don't invest. But the reality is just from this function of auto reinvesting of dividends, you actually pretty much end up, paying for the entire cost, which is the reason why it's such a popular product and people really like it, right? There is no brokerage fees. If you have to do it yourself, the brokerage fees are insane. I mean, you have to pay, even for a small investment, you have to pay the minimum ticket lots and so on and so forth. And lastly, the management fees. If you say, okay, I won't go brokerage route, I will go down to a fund route, is significantly higher for like unit trust and so on and so forth. Then someone asked us, like, how is it different from FinCo? I think there are a lot of differences anyways, to other like fund managers. But I think if you just look on fees, the entry, exit, and the ongoing management fees, which we, a conversation which we cover in one of our, investing 101 series, that amount is significantly, more relevant and all adds up. Now, if you have questions, we are here, of course, to help you. But at the same time, we have a team of wealth experts, right, which can actually help you across understanding, your investments, help you plan for, future goals and better understand how our products might be suitable for you. Melvin is someone, as you can see, has been helping us with this presentation as well. And yes, if you are tuned in and if you have enjoyed this, just scan this QR code right now. And for the first $30,000 for the first 6 months, they will be managed without any cost. So try us out for 6 months, and if you like, please carry on. And in our experience, you will like us. I would say, I was reading somewhere, I think we're looking at numbers, I think almost about 90% plus of our users have topped up with a subsequent, investment. And I hope that same applies for you as well. So you can start with as little as you want or as much as you want, because I always believe that if you have the time, you should invest earlier than later. You can of course use this promo to waive off your fees. With that, I think we are good to take some Q&A. Melvin, let's hit it.
Okay, so a good one would be, there's a lot of interest towards thematics per se, like the up ETFs, also the green sector innovation ETFs. So do you think Syfe will be adding any of them to our current portfolios?
Yeah, so the way how we, think of the setup is that at the end of the day, we are here trying to find a setup where people can, get their returns because that's what they're looking at, or in certain cases, manage risk, right? And when we look at these factors, we are actually a bit agnostic to the fact whether it's an ARC or ESG ETF. We actually look at, trends and then the risk and the correlations and things which we know will be independent of, certain actions which might happen up and down in a particular sector. Now, having said that, whether it's ARC ETFs or some of the, the ESG ETFs, they're very deeply in our consideration. And in fact, if things go per plan, I think in the next 3 or 5 months, you will see a very unique offering coming from us, which will allow you access to these products as well. So stay tuned, and they will be. But I think they could also be included in our regular portfolios as and when they start fitting in our rigorous selection and screening criteria.
Great. So maybe a question for Richard. So growth versus value has been a feature of exceptional market conditions, including ultra low rates and quantitative easing. How do you rebalance if the trend reverses in 2021?
So sorry, what was the first line? I couldn't hear.
Growth versus value has been a feature of exceptional market conditions.
Yeah.
So including ultra low rates and quantitative easing. Yeah. How do you rebalance if the trend reverses in 2021?
Well, I mean, if the trend, I think I showed you a very simple example that we are now in QQQ, right? So QQQ basically embodies growth and large cap, right? Now, I think recently, we wrote a paper that said, when a lot of, investment banks and investment houses were saying, oh, has value come back, right? And what we did was we wrote a little article that says, actually, it's not value that's come back, it's size that's come back, because obviously with this vaccine and all that kind of stuff, then, the small cap stocks, have been performing, right? So if we were to basically reverse, what we would do is then we would go into RSP. You notice that when I showed the slide, RSP basically has a value loading and has a size loading, a small size, right? So if we are basically saying, look, growth and large cap is now out of favor, the trend is reversed, okay? Then we will basically shift from QQQs to RSP. But obviously, it will not be a binary kind of shift, right? It will be kind of almost a morphing kind of a shift, right? So once you see RSP in our portfolio, and we rebalance this portfolio twice a year, once you see RSP in the portfolio, that means we're also getting the signal that the trend has now shifted, right?
Great. So another interesting question is that maybe the past 2 days, most of us noticed the GameStop stocks and so there's a lot of interesting stocks that have been rallied by Reddit. So one question is asking, few stocks has been rising abnormally in comparison with their fundamental financial data due to social media and retail investors. So question is, does your algorithm take into consideration the input from social media sentiments?
Okay, the short answer is no, because basically we don't look at stocks, okay? So if you look at stocks, I mean, stocks are very sexy, and you look at it and say, wow, this guy is going up and down all around. But the bottom line is you have a lot of idiosyncratic risk, right? I mean, for example, you buy Tesla. What are you buying? You're buying Elon Musk, right? If Elon Musk basically kicks the bucket, Tesla will go down, the chute, right? So it's very idiosyncratic risk. So we don't like to look at idiosyncratic risk. What we do is we look at diversified risk. So that's why we use ETFs, right? Now, at some stage when we grow big enough, and Dhruv, raises enough money and so forth, we might end up going into the stock picking business, right? But at this point, I don't think so.
I think we probably never will, Richard, because I think that the reality is that, you can't really pick stocks for people because, no matter what you did, you'll always be on the reverse side. I think the key point, what actually Richard mentioned, and I think the way how we think of it is, and I think this is a bit important, right? When we build Syfe, we've always realized Syfe, or the way Syfe stands now, it's something, or at least, when it comes to these managed portfolios, these are investment options from, for a long term. Of course, you can take out money tomorrow, that stops you. But the idea is they're built at long terms, and in the long term, these things will have their rally, and then they'll have their correction. And eventually, as you correctly pointed out, in the long run, as the company does those financials and all that thing will really, take place. So if you're coming from a long-term investment angle, all these things are noise, right? You saw it with Hertz, you saw the bankruptcy, you saw the rise, you saw the fall again. You will see similar trends in other markets, right? And that's not an area where we want to really go on. As I always say, that is something, which you do if I may, with your pocket money, right? And that brings you a different joy. But But I think, the day we start getting into the game of punting and trying to see does GameStop double or, become half overnight, I think we'll be a very different company, and that's not the company we're going to build, right? We're here for a relatively stable long-term wealth accumulation, not instant spikes and so on and so forth. I think for that, you have your brokerage accounts, and I think they're very good for that.
Okay, so maybe another one would be, does your algorithm take into account forward-looking indicators, or does it rely on just past data?
No, of course, we don't rely on just past data. Basically, the reason why we show a lot of back testing is because what we want to do is that if you can't even prove that it works in the past, there's no shot going forward, right? Now, when we actually do back testing, what we do is we do this thing called point-in-time back testing, which means we don't cheat, okay? We don't look forward. So what we do is we at every point in time, we only use the data that's available up to the point in time. But having said that, when we actually look at the trends going forward, right, we have our own algorithms that basically look forward, and part of it is really based on, I guess, the mathematics of how to forecast, certain factors and so forth. So the short answer is that we basically look forward, and we hypothesize based on the forward-looking elements. Then we back test, to see whether if we had point in time chosen these elements, whether we would have outperformed in the past. Does that make sense?
Yeah, makes sense to me. Hopefully makes sense to, these are also. Great. What's next? Maybe I can take this one, right? I think somebody asked, RE has been negative since the investment in 2020. Any explanation? I think if you look at the numbers, in fact, I was looking. Most of the portfolios actually have given positive returns for the year. I think what has happened is, and this could be a bit unfortunate, when you entered, if let's say the Singapore dollar, and I presume your investment is in Singapore dollar, there's been a significant currency correction of almost close to like 10%, which has happened, right? And I think that has led to a negative performance on the overall aspect, right? Again, as I said, if your focus is around risk management, then it is possible that there'll be phases where you will kind of lose that kind of upside, so as to speak. But you're doing it in a way because you're focusing on risk. If upside is the only focus, and I think Richard mentioned earlier, I think an equity 100 might be a great option, right? And we're also working on some solutions which are a bit more stable and a bit more long term. So stay tuned, for those came out. But again, with RE, the predominant focus is on risk, right? So it's more for people, because in the long run, you will definitely, it's going to be up in the positive, and it will, have its, day in the sun. But of course, we look at like short periods, and I think somebody asked, what is short period? So typically, if you look at 2-3 years, that is like a short period, right? There will be phases you'll have underperformance, outperformance. Tomorrow, if the markets collapse 20%, your RE will like shine the shine. So again, it depends where your, allegiance lies. And I think that's something, what we like to, bring in here. Anything else, Melvin, that we should address?
Let me just take a look. So another one that's regarding about trend, right? So I think people are very interested about trend. So with the current market going all hyped up on the EV market, right? What is Syfe's take on when it comes to diversification for the ETF spot? And also what is Syfe's take on energy sector, as renewable and energy seems to be in the trend now?
Yeah. So I think maybe I'll take this. See, I think, we of course consider all the different aspects and different products we have into our, portfolio, right? And you will see there being certain, like if you think of it somewhere, QQQ has Tesla. There's already like an exposure to this energy vehicle and EV space, right? So there's always in that exposure. S&P, all these are like S&P inclusion. All these things actually already, have in that exposure, right? I think as we alluded to earlier, we are not looking at specific, sector to just look at this one sector and say, oh, this sector is going to outperform. We actually look at how does this fit into our models and how does it correlate to the other parts of your portfolio to bring you, an output, right? I think one of the earlier questions was like, oh, this is the same rationale when we look at, why we look at US versus China and all. And you will see very soon that there will be a phase in which where we will actually get much more global. We will get that right level of comfort. But in all fairness, keeping US in our portfolios last year was the best choice. Clearly, it has done that in our performance in some ways, which is what many users have actually benefited from. So these are things you're constantly reviewing. But how do we say we will not wake up one day and say, oh, today EV is hot, or tomorrow gaming companies are hot, or anything that is not really the way how we want to do this. We want to see about essentially what does this mean, how does it fit into our models, how does it fit if it's, let's say, in the equity 100, how does it fit in with the factors that we are following, right? And how does that get in? And that's how we decide whether a particular sector ETF gets into our portfolio or not.
I think if I may sort of expand a little bit on that, in a sense, we don't look at trends. I mean, we don't follow trends. We don't follow headlines, narratives, the latest thing, So
Yeah.
what we do is we basically look at academically, validated studies,
Yeah.
and then how to systematically look at the market. Because what we do is we want to extract risk premium, because the modern portfolio theory says that if you just spend on stocks, the idiosyncratic risk doesn't give you return over time, right? But systematic risk premium, if you take the risk, you will get compensated because it cannot be diversified. That's the point, right? So that's what we try and focus on.
Yeah, yeah. Great. And then I can take this one, Melvin, like someone's asking, like, essentially, with RE, right? I mean, last year, again, the similar point and all, like, should 2021, should they actually continue with RE or continue to move someone else? I think at the end of the day, you have to ask yourself, what is it that you are really, wanting? If your concern is a correction and you want to manage the risk of your portfolio, RE is still the best option. If you think that, oh, no, I'm a long-term investor, I want to, keep it on and I can take that, 20, 30% correction and, essentially, live with it, right? Then, of course, something like equity 100 makes sense because in the long run, if you're here for the long run, then of course equities will keep on rising and, then you will just essentially, buy purely into an equity play. So it depends a lot about you. As I said, for us, the key point is more that A, to give you an option, but for B, for you to actually also see which of these two do you, adhere to. Because the worst that you can do is that, when things do correct and there will be every market, if not this year, actually there'll be a phase where markets come off, you don't panic and you stay invested. And I think what happened, at least, in the case of, people stayed invested. And yes, they gained, okay, we could argue they gained less than what they would have if they had got something else, but they definitely gained more than all those people who sold. Let's put it that way, right? So keep that in mind. And I think that is something, which is very, very important. Yeah.
Great. So I believe one participant wants to check out the Equity 100 performance. Maybe we can just share it on the screen while we address one question.
Asking that. I can see that. Can you guys see my screen? Hopefully you can see it too, Joyce. I think Peter asked for slide 22 also. That's for you, Peter, like no charges, etc. And Joyce, for you, I hope this answers your question, right? You can see the performance across different years, including last year, and generally how the trend has been, even through different phases, even like last 15 years, which includes the significant correction what happened in 2008. Okay. Great. Anything else, Melvin, that we have to address, or we've answered everything?
I think we have answered pretty much everything. I think pretty much we have answered most of it.
Okay, great, awesome. All right, guys. I hope this has been helpful, and you've learned a thing or two about our offering. I think, as always, if you have any questions, feel free to reach out to any of us, the whole support team, or even the site like Wealth Experts, for any question that you might have. We'd be more than happy, to give you a free complimentary session, explain our offerings, and see how they are better suited for you. Thank you so much for joining us today, and we look forward to being a part of your wealth management journey. Thank you, guys, and have a good evening.
Okay.
Thank you.
Thanks.
Good night.
Bye.
Bye-bye.